What if I told you that right now, White House staff are being formally warned not to place financial bets on global warfare?
Yeah, it sounds crazy.
Right. While at the exact same time, you've got Silicon Valley building an entirely separate multi-billion-dollar economy that is, like, completely immune to that chaos.
I immune.
We're looking at a fascinating stack of market briefings from today, April 10th, 2026. And the core mission for this deep dive is to really make sense of an economic landscape that's just being violently pulled in two completely opposite directions. On one hand, you have the messy physical world, right? Geopolitical shockwaves, wars, and inflation hitting the gas pump. But on the other hand, there's this relentless, logic-defying AI boom that's operating almost in its own parallel universe.
Yeah, we are basically witnessing a fundamental break in economic gravity. Today's sources, they provide this perfect masterclass in how global events instantly ripple into domestic wallets, while, institutional capital aggressively seeks shelter in a sector operating under an entirely different set of rules.
Right.
The stakes for you, the listener, whether you're managing a portfolio or just trying to navigate the grocery store, they've really rarely been this uniquely complicated.
Okay, let's unpack this, because we really need to figure out how these two extremes are coexisting right now. We should probably start by exploring the hardest reality check first, which is the macroeconomic shockwaves hitting the physical economy.
Absolutely.
So the ongoing Iran conflict is causing oil prices to just wildly fluctuate. And we are seeing those direct consequences in the March CPI print, which just spiked by 3.3%.
A huge jump.
Yeah, and the briefing data shows this is largely being driven by massive energy spikes. I mean, it's like trying to budget for a road trip, but someone keeps randomly changing the price of gas while you're driving.
Exactly.
You literally can't plan.
And that inability to plan is the defining characteristic of a supply-side shock. When we look at the mechanics of global trade, the Strait of Hormuz isn't just some shipping lane, right? It is the global economy's most vulnerable choke point.
Right, because of how much oil moves through there.
Exactly. Roughly 20% of the world's oil passes through a space that is incredibly narrow and, frankly, easily disrupted. When geopolitical conflict erupts there, the market doesn't wait to see if a tanker is actually stopped. The risk premium is priced in instantly.
Instantly, yeah.
That 3.3% CPI spike, it demonstrates the sheer velocity of energy costs. I mean, higher diesel prices immediately increase the cost of shipping.
Which obviously hits raw materials.
Right, which immediately increases the cost of raw materials, and then that cascades right down to the retail price of consumer goods. So it functions less like a temporary blip and much more like an infection that's just spreading through the supply chain.
But wait, I'm looking at today's specific commodity data, and U.S. oil prices have actually slipped back below $100 a barrel. And the sources explicitly tie this drop to President Trump issuing a demand for the immediate reopening of the Strait of Hormuz. So I have to push back a bit on the idea of a permanent infection if, a single political statement can just drop the price of oil overnight. Is a 3.3% CPI jump just a temporary blip because of the war? Or does this energy spike genuinely threaten to derail the broader economy?
If we connect this to the bigger picture, we have to understand how algorithmic trading actually parses political rhetoric today. Modern commodity markets are largely driven by automated trading models. They scrape news headlines, political statements, and geopolitical alerts in literal milliseconds.
Oh, wow.
Yeah, so when President Trump issues a firm demand to reopen the strait, the algorithms calculate the probability of a de-escalation or maybe a sudden influx of supply, and they execute sell-offs on oil futures before a human trader even reads the headline.
So it's not even humans reacting.
Exactly. The danger here is the extreme volatility. Sure, a headline can drop the price below $100 today, but a physical blockade tomorrow sends it skyrocketing back up. You just cannot sustainably run an industrial economy on that level of whiplash.
And that volatility is bleeding directly into Washington, which kind of brings us to how our financial institutions are reacting. Because right when the market desperately needs a steady hand at the wheel to manage this 3.3% inflation spike, things are getting incredibly weird.
Very weird.
The nomination hearing for Kevin Warsh as Federal Reserve Chair has just been delayed. And concurrently, in this highly unusual move, the White House has issued a formal warning to its staff against betting on the outcomes of the Iran war on prediction markets.
Yeah.
Wait, White House staff betting on war outcomes? That sounds like insider trading for geopolitics.
It really does.
How does a prediction market even price in something as unpredictable as war?
Well, it functions as an aggregating algorithm for human intuition and decentralized data. So prediction markets allow individuals to buy shares in the outcome of specific future events.
Like whether a conflict escalates.
Exactly, like whether a conflict will escalate by a certain date. The price of the share fluctuates based on demand, which effectively acts as a real-time probability meter. Proponents argue that the wisdom of the crowds often prices in the fog of war faster than traditional intelligence analysts, basically because participants have a financial incentive to be correct.
But gamifying global stability when you work inside the administration,
Yeah.
that crosses a massive ethical and legal line. I mean, a staffer might theoretically have access to troop movements or diplomatic back channels before the public does.
Oh, the moral hazard is astronomical, which is
Right.
exactly why the White House had to issue the warning in the first place.
Mm.
But, stepping back, the existence of this warning highlights a bizarre symptom of our current era. It's the financialization of absolutely everything.
Right.
When traditional financial signals become chaotic, people start looking for alternative beta streams. And that ties directly back to the Federal Reserve delay you mentioned.
Kevin Warsh delay.
Right. Delaying the nomination hearing for Kevin Warsh during a severe inflationary spike creates a massive leadership vacuum. And markets abhor a vacuum. Institutional investors rely on the Fed for forward guidance on interest rates. When you combine a delayed Fed chair with entirely unpredictable energy markets, capital starts looking for an exit from the physical economy altogether.
So the chaos in the macroeconomy and the leadership vacuum in Washington actually explains the other half of our split-screen economy. Capital is fleeing the uncertainty of oil and the Fed and just seeking refuge in the tech sector.
Precisely.
And here's where it gets really interesting, because the AI sector is seemingly defying gravity right now. TSMC, the Taiwan semiconductor manufacturing company, just posted a massive 35% jump in revenue to a new record high.
A staggering number.
Yeah, and this is being driven by sustained advanced semiconductor demand from giants like Apple and Nvidia. And at the same time, a company called CoreWeave saw its stock pop 11% today following a major deal to power Anthropic's Claude AI model. Plus, we're seeing Cohere and Aleph Alpha in advanced merger talks. If AI is the new gold rush, TSMC is manufacturing the shovels, but CoreWeave is building the power grid for the actual mines.
That's a great analogy. What's fascinating here is the physical industrial reality of artificial intelligence. The general public tends to view AI as this invisible floating cloud of software.
Right, just magic code.
Exactly. But the reality is that AI is the most capital-intensive, hardware-heavy infrastructure build-out in modern history. Training a frontier model like Anthropic's Claude requires tens of thousands of specialized GPUs running simultaneously,
Wow.
which requires dedicated data centers, highly specialized cooling systems, and massive, massive amounts of electricity.
It takes the abstract idea of a chatbot and grounds it in concrete, copper, and silicon.
It does, and that infrastructure layer is precisely why this sector is completely decoupled from the chaos we discussed earlier. Enterprise tech giants view AI capital expenditure as an existential arms race. Apple, Microsoft, NVIDIA, they are purchasing every single advanced chip TSMC can manufacture.
They can't get enough of them.
No, they can't. And they are locking in power contracts with companies like CoreWeave because the limiting factor for AI right now isn't software capability, it's access to electricity and compute.
Right.
They will spend billions on this infrastructure regardless of whether the CPI is at 2% or 3.3%, because the perceived penalty for falling behind in the AI race is basically corporate irrelevance.
And non-negotiable expense for them.
Exactly.
But let's drill down into the specific corporate winners and losers within this tech bubble, because today's market scoreboard is incredibly ruthless. The top-line numbers look great for the industry, but under the hood, the competition is brutal.
Very true.
The most active stocks today are the usual suspects. Apple, Microsoft, and Nvidia. Yet the briefing notes that Microsoft's Copilot, which was their flagship enterprise AI tool, is actively being swapped out for Anthropic's Claude by major fund managers. And the reason they cited poor user experience.
Yeah, and that detail about user experience is perhaps the most critical insight in the enterprise tech space right now. We are moving past the phase where having the most powerful underlying AI model was enough. The new moat in the AI industry is UI and UX, user interface and user experience. In financial services, fund managers are using these tools to synthesize earnings calls, analyze risk, automate workflows. If the interface is clunky or if the model hallucinates data in a way that disrupts their workflow, they abandon it.
They just drop it.
Right. Anthropic's Claude is winning market share from Microsoft because fund managers perceive it as more reliable and, frankly, easier to integrate into their daily tasks. It demonstrates that workflow integration is just as valuable as raw computational power.
A massive execution misstep for Microsoft, considering their massive first-mover advantage with OpenAI.
Definitely.
And they aren't the only giant stumbling. Apple just had its highly anticipated foldable iPhone fail durability test, and they are delaying mass production all the way to 2027. I mean, folding glass and flexible circuits sounds like an engineering nightmare, but Apple rarely misses a major product cycle by years.
Right, but the physics of hardware remain entirely unforgiving. You can iterate software endlessly in the cloud, but material science has hard limits.
Yeah.
Apple's delay to 2027 proves that legacy dominance guarantees absolutely nothing when you're pushing the boundaries of physical engineering. The market is brutally impatient, and it heavily penalizes execution failures.
Well, speaking of legacy dominance and execution failures, I want to pivot to the defense sector for a second, because I'm spotting a massive contradiction in our sources. The briefing notes that the defense sector is actively pivoting towards Silicon Valley. The Pentagon wants shorter lead times, they want cost-effective warfare, and they want tech-driven solutions to deal with the exact kind of geopolitical chaos we discussed in Section 1.
Right.
But if the defense sector is rushing to Silicon Valley, why is Palantir, arguably the most famous Silicon Valley defense tech company in the world, having its worst week in over a year? Famous contrarian investors like Michael Burry are actively betting against it, even despite recent public praise from President Trump. If the macro trend is pointing at defense tech, why is the poster child for defense tech tanking?
It looks contradictory, I know, but it perfectly illustrates the incumbent's dilemma. Palantir spent 2 decades proving to the Pentagon that software and data integration were just as important as fighter jets.
Yeah, they really paved the way.
They did. But their traditional business model relies heavily on forward-deployed engineers, essentially sending highly paid software engineers to physically sit with military units to customize the software. It's an expensive, high-friction model.
Oh, so they became the very legacy defense contractor they originally set out to disrupt.
In many ways, yes. The current pivot to Silicon Valley by the defense sector is focused on leaner, hyper-specialized startups that offer off-the-shelf, autonomous AI solutions with much lower overhead. Investors like Michael Burry look at Palantir's massive valuation and recognize that they are no longer the only game in town.
Right, the landscape shifted.
Exactly. They are suddenly competing against a swarm of hungry new entrants who can deliver specific AI capabilities for a fraction of the cost. Praise from a political figure like President Trump might offer a temporary sentiment boost, but institutional short sellers are betting on the structural shift in how the Pentagon buys technology.
Man, the market is ruthless. It doesn't care who you were yesterday, only how fast you can execute tomorrow.
Yeah.
But we need to bring all of these massive abstract concepts.
The billion-dollar deals and all that.
Exactly. The infrastructure deals, the Fed delays, the shifting defense contracts. We need to bring it directly back to Main Street. I want to look at the domestic data in our briefing because it hits close to home for you, the listener. According to the latest IRS filing data, the average tax refund is 11% higher this season. Additionally, the Social Security 2027 cost of living adjustment, or the COL estimate, has risen in tandem with gas prices and the new pace of inflation. So what does this all mean? For the listener sitting in their car or making breakfast right now, an 11% bigger tax refund sounds like a tangible win. But does a rising Social Security COA just mean we are all fundamentally losing purchasing power?
This raises an important question, really, about the crucial difference between nominal number and real wealth. On paper, receiving an 11% larger check from the IRS or seeing your Social Security benefits increase feels like financial progress.
It feels good, yeah.
Right, but these metrics are essentially trailing indicators. They are mechanical band-aids attempting to cover up the structural damage caused by the inflation we discussed at the top of the deep dive.
Because a tax refund is just the government returning money you overpaid. But the dollars you're getting back today are literally worth less than the dollars you earned last year.
Exactly the issue. Due to the 3.3% CPI jump and the rapid increase in energy costs stemming from the Strait of Hormuz, the purchasing power of that refund has severely eroded. It won't buy the same volume of groceries or fill your gas tank as many times as it would have previously.
Wow.
And the same economic law applies to the Social Security COLA. It is an automatic mathematical adjustment triggered by the increased pace of inflation. When the CON estimate goes up, it is not a sign of a healthy economy. It's the system desperately trying to keep fixed income populations from falling below the poverty line due to real-time price shocks.
So the numbers in your bank account get bigger, but your actual standard of living stays flat or even shrinks.
Unfortunate but true.
It's an incredible whiplash. Just to recap the landscape we've explored in today's deep dive, we have the messy, physical reality of geopolitical shocks in the Middle East driving up inflation at the gas pump.
Yep.
We have a delayed Federal Reserve chair nomination creating a leadership vacuum, leading to bizarre situations where White House staff are being warned about betting on wars. And entirely insulated from that chaos, you have this parallel universe where AI infrastructure companies like TSMC and CoreWeave are completely decoupled from the consumer economy and practically printing money, while legacy giants face the brutal reality of execution in the UI and hardware space.
Yeah, and understanding the mechanics behind these diverging trends is essential because they are destined to collide.
Oh, absolutely.
I want to leave you with a final thought that bridges the gap between these two vastly different worlds. We spent time unpacking how frontier AI models like Claude are becoming so reliable that financial managers are actively trusting them with complex, high-stakes corporate workflows. We also explored how the defense sector is aggressively demanding faster, more autonomous technology to navigate modern warfare.
It's like the ultimate collision of the split screen.
Precisely. The question we really need to ask is, how long will it be until we rely on these exact same AI models to predict or even actively manage the very geopolitical supply chain crises and wars that are currently driving up our inflation?
Oh, wow.
If human prediction markets create moral hazards and human regulatory institutions are plagued by delays, will the chaotic physical world eventually be managed by the hyper-rational, cold logic of the silicon world we are currently building?
Turning the AI models onto the geopolitical chaos itself, handing the keys of the macroeconomic machine over to the algorithms. That completely reframes how we look at the infrastructure build-out happening today. It is a heavy, heavy thought to chew on. Well, that is all the time we have for today's deep dive into the April 10, 2026 briefings. We want to thank you for joining us, for unpacking the mechanisms behind the headlines. And as always, we encourage you to keep questioning the narrative. Don't just look at the jagged line on the X-ray. Ask why the machine is built that way in the first place. Stay curious, and we will catch you on the next deep dive.